Tuesday, January 4th, 2022, Monaco 64, home of alternative economics and contrarian views. So the Treasury market kicked off 2022 with a taper tantrum. And what do I mean by that? Well, yesterday morning when I made my video around the same time as I always do, which is just before 9 a.m. London, which would be 4 a.m. Eastern Time. Treasury yields are pretty much unchanged, around 1.53, 1.52%. They're up slightly from the close at the end of the year, 2021. But the move yesterday was quite significant, I would say. It's still early doors, of course, but all along the curve, the Treasury curve, and by that I mean from the 2-year, yields went up by at least 5 basis points, which is a lot. So 2-year was up like 5, at one point even 7, and towards the longer end of the curve, from around 7 to 30 years, it was up at least 10, and in the 10, 20, and 30-year, yields are up 13 basis points, which is 0.13%. It doesn't sound much, but it is a lot, believe me. I know it's not as much as yields were moving back in March of 2020, where we had huge volatility, where the 10-year yield went from 1.3 one day to 0.3 the other. They were moving like 30, 50, 100 basis points in less than a week. And I know the significance of these moves because, as many of you know, I worked as a bond futures and options broker for over 20 years. And I followed Treasury market, which is the benchmark for all other government bonds in the world, every day of my working career, as well as the other government bonds, of course. So I can tell you that a move of 13 basis points higher in Treasury yields, the 10-year, for example, closed the year last year at around 150, and yesterday we traded up to 1.63. That is significant, and I think what the market is saying is warning the Fed. If you dare to taper too much, this is what could happen. Well, and as I said yesterday, I noticed that the Fed has been tapering, but not that as much as they said. And you can just look at their balance sheet. We'll have to keep track of that. Of course, the stock market did quite well, but I'm not sure if that is really an underlying signal of stock market health. It was based on some big moves by a few stocks like Apple and Tesla. So driven by very few issues. And why is the Treasury market so important? Someone might ask, bond markets, no one follows that. Well, bond markets are bigger than the stock market in terms of, size. And of course, Treasuries are supposed to be the risk-free rate of return. They set the tone for all other bond markets, corporate bonds, municipal bonds, mortgage bonds, and they set the price of credit, the price at which people lend and borrow to each other. And the higher this price moves, of course, the more of a weight it puts on the economy, especially on those who are highly indebted, like the U.S. government. So I'm going to show you a chart. I saw someone tweet this chart, and I did a screenshot of it, which was convenient. And it's from Longview Economics Macro Bond. Not sure who they are, but this just shows you how the Federal Reserve has manipulated the bond market, especially the Treasury market, and all other markets as a result, because you manipulate the benchmark market, all the other markets follow. And why is that? Well, because if there isn't too much return in the Treasury market, because the Fed is manipulating it, how do they manipulate it? Well, by doing QE and buying those bonds, then people will try to chase yields somewhere else and drive those other bond prices higher. But as you can see here by this dot plot chart, this is a really good way to show you that the markets are really not real, especially the Treasury market. So what we've got here, that line is where normally the US 10-year yield should be, right? This is where most of the dots are. And so that's the y-axis. You've got the 10-year yield from 0 to 9, and it's from 1991. And the red dots are just the last 5 years where the yield has been. And you can see that since April this year, these red dots are completely somewhere that doesn't make any sense. So what does that mean? So for November, for example, you had the CPI at almost 5%, and the 10-year yield is below 2%. So according to this dot plot chart, if things were normal, if we had a real free market, that red dot should be up around 7%, as you can see. Yeah, so it's totally distorted. So I think the hope here from the Federal Reserve and the markets is that CPI will move down. But I don't think there's a great chance of them doing that. Yes, they're going to try to tinker with the CPI, with the owner equivalent rent, try to make that a bigger component, and then manipulate this owner equivalent rent. They might manipulate it lower. It's a number that it's like made up. They ask people, oh, if you were able to rent your house, how much do you think you could get for it? They don't go out and ask landlords, how much are you charging? Or tenants, how much are you paying? So they could try to manipulate that. But even if CPI came down to, let's say, 4%, that red dot would have to be around over 4% in yields. And you can see that there are red dots when the CPI was lower here towards 2, 3, and 4. But you don't see any red dots for the last 5 years above that line where the average should be. That just goes to show how distorted the market is. And so why does this matter? Well, because all financial markets, as I've said, not just the bond markets, they set, prices are set through the discount rate, and they use the Treasury yield as an indicator for to discount forward earnings, and that's how stock prices are calculated. But and as you can see, in the last 5 years has been totally distorted. And now we have a problem, which is the CPI, or inflation, that the Fed thought was going to be transitory. So we're going to have to see where these numbers, statistics continue to come out at. We know that big corporations, producers have been able to not pass a lot of their cost of production, or what's called the PPI, because they've got a pretty big share of the market. They're able to control things a little better. But now it's getting to the point where if they don't pass the prices to the consumer, they're going to start losing money. So I don't expect CPI to go lower anytime soon. So I think what the bond market is saying is that there's a problem, and a big problem with tapering too aggressively. And that's just going to keep this dot plot chart even more distorted. So I've said many times in the past, if the CPI was at 4%, bond yields should be at 6%, because I remember that when I was working in the markets back in the early 90s, mid 90s, even early 2000s. But as you can see, and this is a great chart to show you how distorted it is. And what about gold and silver? They got hammered yesterday. Of course, people are going to say, well, it's because yields went up, and higher yields are going to be bad for gold and silver. Maybe a little bit, but I'll show you this hourly chart of the 10-year yield. And it goes back to the end of November. It's an hourly chart, though. And this thing about gold and silver going down because yields popped up, I think is a little bit of an excuse for manipulating the market. That's all I think it is. And when the Federal Reserve chases inflation, like it has to now, but it has its hands tied, in my opinion. Either way, gold and silver do really well when they chase inflation. And even if they don't, it's going to continue to do well, in my opinion. And I know we had a year where gold was down about 4%. But when I say do well, I mean in the longer term as a store of value. Yes. So as you can see here, yesterday when I was speaking, the 10-year yield was around 153, I think, just before the US came in when I did my video. And then it just zoomed up, as you can see. Right now it's pretty steady. We got up to 1.64. And you can see here on this chart going back, let's see, we had a top back in October, just around 170, and also at the end of November at 170. So that's the key level in the 10-year yield. The other thing I would say is to look out for volatility. Not only the yield moving up a lot, but also moving down and then back up. And why is that important? Well, because the financial system is highly leveraged, and when you get a lot of volatility, it becomes a problem. People start losing a lot of money. So with that, let's take a look at the markets this morning, where they are. It's 8:45 a.m. London time. We got spot gold at 1805. It's up about $4. Yesterday, I think we traded down to like 1796. The low overnight has been 1801 and the high 1807. So a fairly narrow range. Yes. Nothing's changed in the long term for gold and silver, in my opinion. If anything, it gives us more of a chance to keep stacking. And for those of you in the UK who are looking for a bullion dealer, I would say do your homework, look around on the internet. But if you want to, I have a promo code, Monaco64, with gold investments. I've been dealing with them now 20 years. First time I dealt with Oliver and Simon's father was in 2002. I trust them, and they'll give you a small discount if you use the promo code. Details are below in the description. What about silver? Yeah, silver got hammered down to like the 60s, like 2260s, and then rebounded quite well, almost to 23. But right now we're down about 7 cents, 22.81. High has been 23.04, low 22.69. Stock market. seems to be motoring ahead still. The Dow is up 79 points, Dow future. The NASDAQ is only up 2 points, and the S&P 500 future is up just under 8 points. The FTSE is up 65, just under 1%. To the currencies now, we saw the currencies get hit hard as well, relatively hard. We saw sterling and the euro come off when US yields traded higher. Right now, cable or sterling is up 0.1, just below 135, 134.92. The euro is unchanged, 112.94. The dollar is up quite a bit against the yen. It's up almost 0.5% at 115.82. And the dollar is up slightly versus the yuan. Aussie dollar is up about 1/3%, 72.11. The dollar is unchanged versus the Canadian dollar, 127.50. And the Kiwi dollar is up about 0.2 at 67.94. To the general commodities, we got crude oil up 0.5%, 76.25. High-grade copper is down 0.5% at 439. And one thing I would point out here, carbon emissions futures, which is very significant for the price of energy in Europe, I would say, is up quite a bit this morning as well. We're up, it was up significantly yesterday, and we're up another 1.5%. And we're approaching all-time highs, as you can see here. We're at 82.57. What that does, it makes it more expensive for industrial companies to buy carbon or fossil fuels like oil, natural gas, coal, because in Europe, a lot of countries have signed up to this net zero madness. And one way to neutralize their carbon footprint is through buying carbon emissions. So the more expensive carbon emissions get, the more expensive things get for these companies, and in the end of the day, for the consumer. Not helpful. So we're going to finish off, of course, looking at where the 10-year yield is. It's unchanged right now. It's at 1.63%. Of course, it went up 13 basis points yesterday. I suspect we need to wait until the US comes in to see if we see another big move higher in yields, and that wouldn't be a good thing. Just wanted to say that this week, the key statistic for the U.S. economy will be non-farm payroll. That's coming out on Friday at 8:30 a.m. Eastern time. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.